Hi, I'm Alex. I'm a CPA with Stronghold Accounting. I've helped over hundreds of business owners with cash, tax, and profit optimization. And today we're talking about the 5 ways your business profits are lying to you. So here we have in front of us a typical profit and loss, right, by month, and what looks to be a healthy business, right? So for the month of June, you've got 40,000 in revenue, you've got 36,000 in gross margin, and all the way at the bottom, you've got 32,000 in net income. So what's wrong with this picture? What's driving the alteration that you should be seeing as a business owner? Well, the first driver is your owner's salary. And what I mean by that is the W-2 wage you pay yourself. So for example, if right now as a business owner, you're paying yourself $50,000 in salary, but in reality, if you were to hire someone on the marketplace to take over your duties in the business, you would need to pay them for their skill level and expertise $120,000. What you're doing is you're overstating your profits by $70,000 per year. See, the way you have to think about your business is an investment, right? So your W-2 salary that you pay yourself should be based upon what you do, and your distributions should be based upon what you own. Because from a buyer or an investor's perspective, they're going to want to know, if they buy your business, hey, what does it take to replace CEO X with someone else from a fair market value perspective? And so when we make this adjustment of 70,000, what I do here at the bottom of the P&L, if I go back to the by month, is you can see the adjustment per month. That's a $5,800 adjustment to the profit per month. So it brings us from 32,000 before to $26,000 in profit after, because we want to normalize your salary so we can look at it from an investor's perspective. The second, third, fourth, and fifth on the list, just as a high level, are going to be your estimated taxes, your debt payments, building cash reserves, and distributions. Let me go through each in depth. First, your estimated taxes, right? You want to be setting aside anywhere from 30 to 40% of your net income to pay the IRS quarterly. So if we look at this here, if you profited a net income of 32,000, right? You want to set aside 30%, which is going to be 9,700. So if you're treating that 32,000 as if you're keeping it all, you're going to be really upset at year end. So it's best to set that aside, pay the minimum amount to avoid a penalty, and invest the rest in a high yield savings, get some interest throughout the year. But that's something owners need to be cognizant of is, hey, that 9,700 is no joke. That's a significant amount that you need to be realizing throughout the year. Okay, the next thing is your debt payments, right? So business owners don't realize if you took out a loan for equipment, you have a loan with the bank that you're paying monthly, that payment does not show up on your profit and loss. Again, that payment does not impact that 32,000 here. Only the interest on that loan impacts the net income, right? So that only shows up on the balance sheet. So that 2,500, let's say you pay per month, we need to factor that into the cash going out the door, right? The third thing, or I should say the fourth thing, is building your cash reserves, right? The rule of thumb for your cash reserves is 2 months of operating expenses. Okay, so if you don't have 2 months of your operating expenses with cash on hand, you need to be setting, before you're taking distributions, right? So this is after tax, after debt payments. You need to be setting aside funds to build up your cash reserves in case anything happens, you're comfortable enough to where you have 2 months of operating expenses still saved. Okay, the last thing is your owner's distributions. Same thing as debt. This doesn't show up on your profit and loss. So, by the way, it's not taxed either. So if you're taking out $20,000, $5,000, it's not taxed, and it also doesn't impact your net profit. So after all of these factors are considered, I call this your profit after commitments, right? All of the balance sheet commitments, tax commitments. You started with 32,000 in net income. You adjusted for your salary of 5,800 per month. You went down to 26,000 after estimated taxes, debt payments, building your cash reserves, distributions. You're at a net loss. And that's the key piece of why you may be seeing profit on the P&L, but your cash balance is going down because you have all of these other commitments to consider. So just to recap, those are the 5 ways that your profit is misleading you on the P&L, and I hope this helps. I just don't think the way the accounting standards are set up in terms of P&L is helpful for a true business owner to get a read on it. So that's why I like to make these adjustments when I'm reviewing on a monthly basis with clients. Again, my name's Alex with Stronghold Accounting. Thanks so much for watching.